Hey guys, it's Chris Mancola with the Mancola Group over at West USA Realty, and I'm doing our weekly market update. It's been crazy busy, and I will tell you anecdotally, the market is improving as far as getting quicker, faster sales. We're even starting to see multiple offers, so let's jump into it. I'm going to share my screen here with you, and here we go. So, first thing is we've got a new Fed chairman that's been picked. He won't be into his first meeting until June when Jerome Powell leaves in May. Um, but it's Kevin Warsh, and that's Trump's pick. So, some quick rundown. I just got you some bullet points here about him. I could do a nutshell, but I just figured I'd run through this really quick. American financier and bank executive born in 1970 in Albany, New York. Oh, right up near where I'm from originally. Former member of the U.S. Federal Reserve Board of Governors from 2006 to 2011. Became the youngest Fed governor in history at age 35. Acted as the Fed's primary liaison to Wall Street during the Great Financial Crisis in 2008, served as the Fed's representative to the G20 and emissary to Asian economies. Early career included investment banking at Morgan Stanley, mergers and acquisitions. Make sure I'm on here. Okay. Um, Served in the George W. Bush administration as special assistant economic policy and executive secretary of National Economic Council. Education, Stanford University BA, Harvard Law School JD. Okay. Post-Fed lecturer at Stanford Graduate School of Business, Hoover Institute Fellow, and corporate advisor board member. Married to Jane Lauder and heir to Estee Lauder fortune, and nominated by President Trump as of January 30th, 2026, to be the next Fed chair. So, um, a couple of things also to know about him. In the past, he's been known for being very hawkish, which means he's about fighting inflation, maybe keeping rates a little bit higher, a little bit longer during the great financial crisis. That was a thing. But he knows Trump, President Trump, through the family, through the Estee Lauder marriage that he has been involved in with the Trump family. So basically, in a nutshell, you're going to see Kevin Warsh 2.0. Okay. I really don't care as long as he helps to make things more affordable and it makes sense for the markets. A lot of people were kind of scratching their heads when this came out because he's known for being hawkish rather than dovish. And President Trump wants lower mortgage rates and a lower Fed's fund rate to help pay off the national debt. Makes sense, right? But the bond market, we'll have to see, right away, the bond market went up a hair and then it just kind of stayed at a normal level. So far, there hasn't been much pushback from the market by him, from him coming on as Fed chair. So we'll see how it all plays out. I think when I say you're going to see Kevin Warsh 2.0, I think as long as President Trump is in there, we'll probably see him be very dovish on his messaging. 65 to 75%, as Logan Mohtashami explains from Housing Wire, chief economist over there. He basically explains that 65 to 75% of what happens um, with is what makes up the market changes that go on with the Fed. So when it's not so much that they maybe lower a rate by 25 basis points, it's their whether or not they're hawkish or dovish. So are they moving towards the more neutral policy, which a lot of people think we should be at right now? We should be, by a lot of people's estimations, around 3%. Right now, we've got trueflation coming in under 1%. I know a lot of people love trueflation. A lot of people hate trueflation, but it really takes. It's like doing it the old way. With owner's equivalent rent, where the BLS will call people and ask them through surveys over the phone how much they think their home would rent for. And that's how they come up with a third of what makes up the CPI inflation that we always hear about all the time. That is really an outdated marker, a way of doing things that goes back to the 80s when now we have real-time data. Now we even have AI on top of things like MLSs and Zillow and all these other real-time data sources that you can plug into AI. And yeah, AI is not perfect, but it certainly can be double checked and you can get real-time data. And that's basically what Trueflation does. And if you go to their website and you look at their charts, they line up because especially Jerome Powell, who's very antiquated in his models and the way he's doing things and very rudderless when it comes to forward-looking thinking and guidance to the markets. And that's what the markets look for. That's what the bond market looks for. That's what the 10-year treasury runs on in a nutshell. And the reason why that's important, besides looking at the inflation and the jobs numbers, kind of dictates that 10-year treasury and the bond market in general. But that 10-year treasury we call it the slow dance between the 10-year treasury and the 30-year mortgage rate. Okay. And historically now, the historic range is between 1.6 and 1.8%. So in other words, the 30-year mortgage should be in that range higher than the 10-year treasury. And that's what's happened over the last year. That split was like a whole 100 basis points or 1 percentage point or 125 basis points higher. So right now, mortgage rates would be much higher if those splits over the last year hadn't gotten better, which they have, which is the real reason why mortgage rates have gotten better over the last year. Okay. And why things are starting to loosen up a little bit in the market, which we'll talk about in a second. So he, I'm sure that hey, he's going to get in there and he's going to do his thing. He certainly has the experience. He's been in the Fed before. He's talking about taking money off their balance sheet, which is a good thing long term. Short term, it may have an impact that we don't want to see. We'll have to kind of see how that plays out. It depends on how much Fannie Mae might get involved in buying those mortgage-backed securities. But that will be his call, is to keep things in a dovish mode, getting us to neutral or maybe even at some point an accommodative stance. But the jobs market, we're right now, they're predicting that the jobs market may hit some volatility, which it already has, because we've seen that the hiring has been very, very low. But in order to get lower rates as far as that's concerned, we should see we would have to see unemployment go up to let's say 323,000 for a 4-week moving average, more towards a 4.6 to 4.8 level, maybe even close to 5 before they really get to the accommodative stance. But as far as many are concerned, when you look at Trueflation and some of these other real-time, not rear view mirror data, and when you look how weak the jobs market is because companies run on credit and builders run on credit to source their land and their properties, and housing touches so many of those sectors. So when you see like we have manufacturing and housing, construction workers, hiring down, or unemployment happening there in that sector, which we have over the last year or two, then you run into an issue where, you could already be behind the curve. And I think we're already behind the curve, like many do. And we need to play some catch up and at least get to neutral. Where's neutral on the Fed rate? Should be between about 2.5 to 3.25, right in that range would be a neutral. So we'll watch for this. We'll track this, obviously, like we always do. But that's that in a nutshell. That's Kevin Warsh. Okay, so let's just get rid of this. And then other article I wanted to show you was U-Haul. U-Haul Growth Index, top U.S. growth metros and cities of 2025 announced. And Guess what? Phoenix is number 5 in the metros where people are moving to, according to U-Haul. Okay. Places like Texas and Florida are still at the top of the list. South Carolina, 10 cities top the list in the top 25 metros in Florida. So that's huge for Florida. That's huge for Phoenix. We've got a lot of growing here going on, especially with the tech sector, medical sector. So lots happening there. National single family housing inventory, we could see where we are off to a great start for 2026. So if you're thinking about listing your home, inventory isn't crazy elevated, but it's higher than last year. Okay. Maybe there are people who just couldn't wait anymore. They had put their house on the market. Maybe their home didn't sell last year, and they took their home off the market for the holidays. Well, we see sellers are back, and we see that mortgage applications are soaring, guys, soaring. Okay. What that tells us is 30 to 90 days out, it gives us a really good channel and indicator of where things are headed in the housing market. So this is good news for people jumping back into the market. They're getting a mortgage application. That means they're going to be out shopping for homes. Maybe some of those people already have listed their homes for sale too. And then you have the buyers that aren't selling that just need to buy. But that is elevated. Last year at this time, right around, let's see, we're in February. This actually takes us to the end of January. So 193.3 versus last year. Let's see, let me grab the same day, 162. So we see this number soaring. Okay. We'll keep an eye on that as we move along, but that gives us a really good indicator of where things are headed. Housing demand is still positive, even with epic snowstorm. Logan Monashami says from Housing Wire, mortgage rates remain near 6%, and purchase applications are up 18%. 18%, guys, year over year, defying expectations. So we see that it's on a steady course and a very positive course right now for 2026. So if you're thinking about selling your home in 2026, I would get ahead of the other inventory if you can. I know you got the kids in school and everything in a lot of cases. Maybe things you just can't do it right now. You got to wait 2 or 3 months. But if you can, get your house on the market now, because you want to be on when other people are not on, but that purchase demand is out there. Okay. Last year, we were at 288,605 for total pending sales at this same time. And right now, towards at the end of the month, we are at 290. So the pending sales are already elevated over last year. That's a good sign. And we can see home price reductions. This has been a big story over the last year. We had, a third of homes when they're listed, about a third of them will not sell the first time. Okay. And we see price cut percentages along with this idea that right now, right in this range for 2025, we're at 33%. Right now, we're at 32.71. So that's improved a little bit. Okay. I think that number will probably continue to go down, in my opinion. That's just my opinion, because the affordability over the last year has just basically, you had right around 100 basis point, using round figures, about 100 basis point or more drop in mortgage rates because the spreads got better. Even more than what's going on with the Fed, the spreads got better between the 10-year Treasury and 30-year mortgage rates. So with the better affordability, that's the quickest way to get affordability right now, is a lower mortgage rate, and why we want the dove at the Fed. All right. Kevin Warsh. So jobless claims, we show this because We want to know, basically what the Fed's looking at and what their policy is going to be on this because their dual mandate is inflation and labor over inflation. And jobless claims right now are at 209,000. They've definitely gone up a little bit over the last month or so, but nothing out of bounds there for people to go nuts for. But we over the last year, we definitely had some elevated points and job starts, new jobs just haven't taken off like we want to see. And the good news is we see things like PPI and other inflation factors. PPI came in a little bit higher than expected, but it's down 0.5% year over year, which is basically that wholesale number for inflation, wholesale costs. So that's always a good sign also as another indicator of where things will be. And that's kind of a forward looking out. That's another forward indicator because you start with wholesale and you go to retail. Okay. So all good indicators. And here's the spread right now between the 10-year treasury and the 30-year mortgage rate. It's at 1.86. That's basically the high end of the historic average. But here's where we were the last couple of years, guys. I mean, 2024, we're at 2.26 at the end of December. And in 2025, we ended at about 2.05. So, the end of January going into February, we're at 1.86. That's amazing. That's amazing. And we look at it today and where we are, this month, and we can see, it's at 4.2. So again, looking out, that number there, thinking, okay, the spreads, 10-year treasury, where should we be on mortgage rates? Well, let's see. We are at today, the 30-year fixed rate is at 6.17. Going back here, pretty close to that number, those numbers. Again, it's at the high end of the historic norm, right? Getting right where we want to be. So hopefully that gets even closer together within the historic range, and we'll be doing just fine. Now, with mortgage rates, again, we work with a local mortgage broker here, and the rates are a little bit lower a couple weeks back, but right now our mortgage broker has rates conventional at 5.5, FHA 5.1, VA 5.125, and jumbo at 5.6. So, you go with a mortgage broker in a local area because they're going to shop the best rates. They also aren't going to charge as much in their own fees and commissions. They don't have the brick and mortar, all the junk fees, as we call them. So you definitely want to work with a mortgage broker if you can to save tons of money. Let me know if you have any questions on that. I'd be happy to go over it with you. Right now, we're heading towards, just a month ago, this market index number was from Cromford was just 4 points lower. When it reaches 90, we can see here our supply is almost at 100. Our demand index is up from where it was a little bit. But when these two numbers are the same, this number here will be at dead 100 center, which gives us a balanced market at that point. Okay. So right now, the greater Phoenix area is in a balanced market. Okay. I'm sorry, in a buyer's market technically, but almost once we hit that 90 mark, we start getting into the balanced range, which makes sense because when we look at the local numbers here, that's basically what it's telling us. And we're at 89 days closed on market, 5.21 months supply. That means if nothing else came on the market, it would take 5 months to get rid of, just over 5 months to get rid of it all. This puts us in a balanced range because anything really between the 4 to 6 month range puts us in a balanced market. If it were over 6, then we'd be in, that strong buyer's market. Anything below a 4, we start getting into the 3s and lower. That puts us into a seller's market. That's historically what has always been felt in the real estate industry. Absorption rate has gone up a little bit at 19.18%. And just last week, this month's supply was over 6. So that's changed a little bit. And this closed days on market just a week or two ago was over 90. So we're starting to see things loosen up a little bit. Again, it's not going to be like a rocket ship. With some of the things that we've heard over the past couple of weeks, before I get into more of this, home prices aren't controlled necessarily by politics. Now regulation, permitting, prices on stuff that builders have to get, lowering, of the Fed rate being more dovish, those sorts of things will help loosen things up even more, of course. But certain areas are going to be able to do more building than others, and as far as the country is concerned, here in Arizona, we could definitely have more building going on than, let's say, up in the Northeast. Okay, so historically, home prices only fall nationally when their housing credit breaks, and that's not happening today. Ever since the great financial crisis, there's a lot of guardrails in there as far as how people get pre-qualified to buy a home. That definitely changes how much supply is going to get eaten up. If homes were truly unaffordable, sales would be collapsing and inventory would be surging, which isn't really instead demand is holding and supply remains kind of tight overall. So I mean, we'd have to triple our inventory to be where we were during the great financial crisis, and that inventory were homes that people were losing. It wasn't like they were selling it and then going to buy something else, which is normal. Where you've got 70 to 80% of people who are selling a home are also buying a property. So there's all these different factors in there. And our foreclosure numbers across the country, they're in the normal range since we came out of the pandemic. They're in the historic norm. So there's nothing crazy going on there. Artificial fixes, you know, uh, just simply don't work. To kind of distort the market. Whenever you're giving tons of incentives, also, it can really distort the market a lot. So, mortgage demand's quietly improving. And we've got rates helping out the situation just with the normal course of things, with the spreads getting better. So we'll kind of see how this all plays out. But anyway, let's jump right back in here to the data. And our average list price is 785, 708, which is definitely elevated from last year, as well as the average sales price at 615, 996. Nothing crazy, but it's up a little bit. Our list to sales price ratio is 97.15%. So sellers are either reducing their price or they're giving up some in concessions to buy down rate or pay for closing costs there by almost 3%. The actives are up 0.7%. Pendings, last week, pendings were up 23%. This week, pendings are up 5.3%. And we've got closed units at negative 3.4%. But keep in mind, we're coming out of, usually an escrow period is about 30 days to 45 days. So keep in mind, we were coming out of the holiday season. I think we're going to see those closed units go up. But that's just week over week. Okay. New listings come on the market, overall negative 3.4, but we're over that 2,400 mark. We like to see over 2,400 on a weekly basis here in the greater Phoenix area. Okay. So, right now, our price ranges from 0 to 200 are down a little bit by 1.35%. And also the 5 million plus is down 1.88%. Everything else is up a little bit, except for this 2 million to almost 3 million range in pricing. That's down 0.47. The overall inventory from 0 to 600,000 is at 6.8 or 67.04%. 600 to a million makes up 18.67%, and 1 million plus makes up 14.29% of our supply. Okay. So there's a quick rundown on that. Now, looking at these areas, I can tell you we're starting to see some hot areas again in the greater Phoenix area. This is the contract ratio heat map from Cromford, and in 85024 in Phoenix, that's in a hot area right now when they take the actives compared to what's under contract. Okay, anything between that 60 to 80 range gives us the hot range over here. Whoops, that just jumped on me. And Gilbert has a couple of zip codes that are in the hot range, 85234 and 85296, along with Mesa at 85203. That's in the hot range. But you can see whereas before everything was kind of really cold, now we're getting more balanced to warm areas here in the valley. So we've still got some cold areas for sure, but we're starting to see things switch up a little bit. I could tell you just again, anecdotally, from what I'm seeing at open houses, properties going. These are just three of our listings, my own listings. This property here, it's marked as active in Sun City, and this area has really been hit hard with just sales volume really down and everything. We just in 1 week we just got a cash offer on this property, so this will be under contract. Escrow should be open today or tomorrow, and then this property here, this property's been on the market about 17 days, but the average for the area is running between. Let's see, it's running at what do they have? 65 days on market for that area, Pleasant Valley and Peoria. We're having an open house this weekend from Saturday from 12 to 3. Come and check it out. It's a beautiful property. Show you here real quick. Look at that pool. Look at that. You get the sunset with the mountain view. Beautiful. It's got a 3-car garage with extended 4-foot extra parking, own solar. It's got an RV gate over here for RV parking. You can park all your toys there. And it's just a beautiful home, 4-bed, 3-bath. It's got a Jack and Jill. It's got a chef's kitchen. It's got a fireplace. It's a beautiful property, and we'll be having an open house there this Saturday from 12 to 3. So come check it out. It's a gated community. It's beautiful. We'll have a gate code up there for you. So if you come out, but yeah, own solar on that. So Pleasant Valley in Peoria, great property. And this property here just went under contract in Gilbert in that 85295 zip code we were talking about earlier in that hot market area. We had multiple offers on this just this past week. So I can't tell you what it went under contract for, but I can say we were right there, right there. Place shows like a model home. Beautiful, beautiful property in Cooley Station. So anyway, guys, that's what I got for you today. If you guys have any questions at all, want to know what your home is worth, want to know what we would do to get that property sold, let us do a 10-15 minute walk through your property, give you some ideas on what you can do to get it ready to present for sale. We'll give you some comps, 3-point way of different ways of marketing that on price, and our complete comp package. And we'll go ahead and explain to you what we would do to get your property sold, like we got these other properties sold. So, guys, if you have any questions at all, feel free to reach out anytime. We'd love to be able to help you out. And you could work with our mortgage broker, save you tons of money on your mortgage. And we can always talk about how we can negotiate your rate down even lower than what we showed you on that chart. Thanks. We'll see you next time.